Welcome back to More Fun with Finance. I'm Dr. William Elliott in my studio in beautiful uptown Shaker Heights. And today's topic is short-term financing. This is Chapter 6 out of Ross Westerfield, Jaffe, Jordan, and Shue. And we'll be going over in particular cash cycle and how to figure it out and how to finance it and that sort of thing. So without any further ado, let's switch over to the slides and I will get out of the way here. Let's see here. Let's get to page 1 and we'll get going. So here's just a graphical representation of the balance sheet, and this is hopefully to help you visualize not only the current assets and the current liabilities, but the difference between the two, the shortfall between assets and current assets and current liabilities, known as net working capital. And obviously, that's this area right here. Now, certainly this is suggesting that this net working capital is financed with long-term debt or a portion of it. Obviously, it may not be this much of it, but you get the idea that the amount of current assets that we require often exceeds the current liabilities. Now, we'll talk about in a perfect world why we might actually want the two to match each other and why net working capital in an ideal setting should be, at least from a financial perspective, should be 0. But that's later in the chapter. So let's get started first with just figuring out what it is that's contained in both of these categories, both the current assets and the current liabilities. And so under current assets, we have obviously things like cash, marketable securities, accounts receivable, and inventory. Those are the dominant characteristics or dominant accounts that are in current assets. Under current liabilities, we usually have accounts payable. Oftentimes that makes up the bulk of it, that and notes payable. On occasion, you'll have expenses payable as well in there. So those are the two categories on the balance sheet. Now, how do we figure out what the net working capital is? They give you a couple of different definitions here in the text. This second one is really the one that I always think about, net working capital. It's simply this current assets, cash plus other current assets is the way the authors phrase it, minus current liabilities. Yeah, you could think about it this way. I'm not sure that there's a whole lot of intuition there or that it's particularly helpful. You can also redefine cash in this way as current liabilities plus long-term debt plus equity minus current assets minus fixed assets. Not sure why you'd want to do that. It's this definition that I usually work with, that simply current assets minus current liabilities. It's the amount of current assets that are actually financed with long-term debt as opposed to the current liabilities, which is short-term debt. All of the categories in current liabilities are short-term debt. All right, so how do we increase cash? Well, several ways. We could issue debt, right? Increase long-term debt. We could issue additional equity, a seasoned equity offering. That's another way to do it. We could increase the current liabilities. So in other words, that's not using cash. That causes cash to be greater than if we were to have spent it. So those are ways of increasing cash. We could also decrease fixed assets. Yeah, we basically think of it this way. We're selling fixed assets, right? That's how and we get cash, and that increases the cash balance. And then we could also decrease non-current, or rather non-cash current assets. So if we sold some of our inventory, that, pardon me, cut this out. If we sold some of our inventory, for instance, that would generate cash. If we were to factor some of our accounts receivable, that would generate cash for us. So those are ways of increasing cash. Now, this graphic here is quite useful and quite helpful. This is what we're going to be working with for the bulk of this chapter. So I've actually carried it on to a future slide here just so that it refreshes our memories. But we can think of this operating cycle in one of two ways. It's either the period that's known as the accounts payable period, the time from the time that we purchased inventory till the time at which we actually pay for that inventory, which is right here. So that, depends on what sort of terms we might have for the inventory as to when we would actually pay it. It might be 30 days. It might be 10 days if we try to get the 2% discount that often is given if you pay early. It might be 45 days. All depends on the terms that we negotiate with the seller, with the supplier of the inventory. And then the other portion of the operating cycle, when we're on that frame, would be known as the cash cycle. So this, you can think of the beginning of this point right here. That's when cash flows out. We're paying for our inventory. We received our inventory previously, but here we're actually cash out the door. And until over here, we don't get that cash back. So this is known as the cash cycle. All right, so that's one way of thinking about this. The other way is to think of this same operating cycle as the period of time at which we purchase the inventory until which time the inventory is sold. What's selling inventory? No, think of it this way. We take that inventory, we produce whatever it is we're producing, widgets, boats, cars, you name it, and then we sell that. So that's when they say inventory being sold, it's actually part of the product that we're producing here. And that period of time between when we actually purchase the inventory to the time we actually sell that inventory or make a sale of the products we produce, that's known as the inventory period. And then once that's completed, once we've sold that product, and here we're assuming that we actually sell it on credit, that begins the accounts receivable period. And so at the end of that accounts receivable period is when we actually receive cash from the buyer. From the customer that we sold our product to. So that, again, depends upon terms. We can usually set those terms. Sometimes we have to negotiate. Sometimes we have to extend it and so forth. But we can think of that operating cycle in both these ways. One is the inventory period plus the accounts receivable period. The other is the accounts payable period plus the cash cycle. All right, so keep that in mind. And what we're going to do next, we're actually going to figure out the whole length of this operating cycle by using inventory turnover and accounts receivable turnover. And then we're going to figure out what the accounts payable turnover is. And we're going to subtract that from the other two. And voila, that's going to give us our cash cycle, the number of days between which cash flows out until cash flows back in. And that's important. Why? Well, it's important because we need to know if we have sufficient cash to hold us over that cash cycle. Or are we going to have to go out and actually borrow some money from the bank to tide us over until cash actually flows back in? All right. So I've already really talked about this. The cash cycle is the operating cycle minus the accounts payable period. That's obvious, though. Here's the operating cycle minus the accounts payable. That difference is this cash cycle right here. Let me clean this up before we go on, just in case we want to come back to it, and I don't have a mess of scribbling on it. All right. So, like I said, the way we do this is we actually look at the number of days in inventory, receivables, and payables, and then that difference allows us to calculate the cash cycle. So I've color coded this to help us follow it. So I've color coded inventory as red, accounts receivable as green, and accounts payable as blue. We assume we have net sales of 1.15 million and cost of goods sold of 820,000. And then we have a beginning and an ending balance for all of our three accounts here: inventory, accounts receivable, and accounts payable. All right, so first let's get the inventory period, number of days in inventory. So we want to use an average, the beginning and the ending, divide by 2. That gives us an average inventory of 250,000. On a cost of goods sold total over the year of 820,000, we scale that by the 250, which means that we turn our inventory almost 3.3 times every year. So that average inventory gets turned over 3.3 times in a year. Or if we simply take the number of days in a year, we can figure out the number of days before we run out of inventory. Now, obviously, we're always replacing inventory, right? But this gives us an estimate of that 250,000, that $250,000, turns over in 111 days. And we do that 3.3 times per year. Okay, so now we know the length of this period right here. All right. Now we can look at the receivables, the accounts receivable right here. And this obviously is in the green. So here is our beginning balance. Here is our ending balance. Divide that by 2 to get the average over the period. And then, of course, we're going to divide our sales, at 1.15 million, by the average accounts receivable balance. And that tells us that we turn over our accounts receivable almost 6.4 times in a year. So that means that every 57.1 days, we're turning over our accounts receivable. Now, the sum of those two is down here in the purple, and that is the length of our operating cycle. Let me get out of the way here. That's 168.4 days. Okay? So this is the 111.3, and this is the 57.1, and together these guys add up to 168.4. All right, so we know the length of our operating cycle. Now all we need to do is to figure out what is the accounts payable period. How many times do we turn accounts payable every year? And then we can calculate the number of days. We can subtract that from this 168.4, and we end up with the cash cycle. So let's do that now. So here are accounts payable. Again, beginning and ending values. The average is 87.5. We divide, again, because it's payable, that's related to inventory. So that's, we're dividing the 820 by the 87.5, and that tells us we turn our payables 9.37 times every year, or almost 39 days in that cycle. So we can subtract that 39 from our 168, and we find that our cash cycle is 129 and a half days. So we have to finance our inventory for 129 days effectively. If we wanted to reduce that, we could do so. We need to look at our receivables. We need to look at our inventory period. We could even look at our accounts payable period, though we have less control over that. We have a lot more control over inventory and accounts receivable. Before I move on, let me back up to that to this graphic again and talk a little bit more about this inventory period. Now, we could even break this up into smaller pieces and say, this is the period of time where inventory just sitting in the warehouse, in the stock room per se. And then it goes out to the production department or the production floor, and we've got work in process for a period of time. We might even have a period of time where the finished product is sitting in stock somewhere. So we may have that sitting there for a period of time. So all three of these sub-periods of the inventory period could be manipulated. Maybe we have less time sitting in the stockroom. Maybe we try to figure out a way to build things just in time. There are multiple ways that we can deal with this. Also, on the accounts receivable, if it's starting to stretch out a little bit, and, when we look at this number here, we have 57 days in accounts receivable. Well, maybe we can shorten that up. It might be that we're offering terms that are a little too generous. And if we tighten that up, we can reduce that cash cycle as well. Those are the two primary ways. The other way, obviously, if we stretch out our accounts payable cycle period, we could actually reduce our cash cycle that way too. But like I said, that requires that we deal with the supplier, and the supplier depends on where the power lies, right? If we're the dominant revenue stream for the supplier, sure, maybe we can push that out to them and say, look, we need 45 days instead of 30, or we need 50 days instead of 40, or something like that. All right? Okay. Then the authors start talking a little bit about this flexible versus restrictive types of financing policy and current assets. So I think the best way to look at this is in the graphic here, but let's talk just briefly about the differences between flexible and restrictive. The flexible for the amount of current assets is high levels of current assets relative to operating revenues. Okay. Restrictive would be low levels of current assets relative to operating revenues. And then on financing, we can also have flexible versus restrictive. We would have low levels of short-term debt financing our current assets, and then restrictive would be higher levels of short-term debt. So, flexible terms mean larger cash balances, maybe larger inventory amounts, maybe more liberal accounts receivable. So the liberal credit terms are on the customer side, the selling side. Restrictive would be really keeping the cash balance to a bare minimum, maybe no marketable securities, inventory just in time, and maybe no credit sales whatsoever. Cut the accounts receivable, so that would shorten things up considerably. The problem is that each one of these things may cause us to lose customers, right? So there's a balance here. It's not necessarily one is better than the other. It's just that one might be the best fit and might maximize our level of sales. We attempt to minimize our costs to the extent possible, but we also want to maximize our sales. This graph really says it all. So if we think of carrying costs on inventory in the green here, and we think of shortage costs. Now, shortage costs could be lost sales. Or it could be we have to pay double for shipping to get something to the plant to finish producing an item for a customer. You can think of it in those terms. Carrying costs are, how much does it cost to keep a large inventory? What are we giving up by keeping large cash balances? Well, we're not investing those. Maybe we should invest those in marketable securities and at least make a little bit back on them. But if you think about these two things as countervailing forces, as we increase the level of current assets, so you've got current assets down here on the x-axis, and we have cost over here on the y-axis. So think of this as both, it's representing both the carrying costs and the shortage costs. All right, so as current assets go up, the carrying costs go up. So as we move to the right here on the x-axis, carrying costs go up. As we increase the amount of current assets, the shortage costs actually go down. Now, we're looking at the sum of these two costs, and we get this convex to the x-axis thing here. And what we can find is that there's a point here, if we take a horizontal line and start moving it up, wherever we touch, that's the minimum cost, total cost between both carrying and shortage costs. And that would be, presumably, that would be the optimal level of current assets. All right. So we can think about it in these frames. Now, what we're going to do next is we're going to change carrying costs and or shortage costs. So think about this as we increase, if we were to increase the shortage costs, in other words, let me just give you an example. Let's say that if we didn't have an item on the shelf when a customer walked in, that customer would walk next door and buy it from our competitor. It's a pretty serious, and they might be become a long-term customer. We might lose that customer. And that could be a very expensive thing to do. So in that case, as that curve rises, notice that and by the way, where these two intersect is the way these curves are drawn anyway in this example. Where they intersect is the optimal. So that would shift our optimal level of current assets to the right. Increase. That would be a more flexible policy on current assets. Larger cash balances, larger inventory. And that inventory could actually include finished products. Certainly would include work in process, and that way we would never lose a sale. Likewise, or actually in the opposite direction, if our carrying costs were to go up, and let me clear off this muck so that you can see it more clearly. So if our carrying costs were to go up, this line would shift this way, and our optimum level of current assets would go down. That means that we would want to lower our cash balances, lower our marketable securities, lower the amount of inventory that we have. So here's an example of if our shortage costs went up and or our carrying costs went down. And that's going to shift us, where previously we were over here, that's going to shift us to the right. And then the counter example would be when carrying costs go down and or, when carrying costs go up and or shortage costs go down, then that is going to shift, from here over to the left. And this would be a more restrictive policy. We're going to have fewer balances in the cash accounts. We're going to have lower levels of inventory, including WIP and including finished products that might be sitting in the stock room or stored somewhere. Now, on the financing side of things, a more flexible short-term financing policy means low proportions of short-term debt relative to long-term financing. All right. So, in other words, the current liabilities are going to be smaller relative to the other portion that finances current assets, which would be long-term debt. More restrictive short-term finance policy would mean that short-term debt is higher relative. So that's where we drive net working capital down towards zero. We would reduce that. And as I said earlier, in an ideal world, we really want these assets to match up, right? You don't want to borrow a 5-year loan to buy an asset that only has a 1-year life. That would be really not very smart. Another example would be, you don't want to finance a car that's not going to be operational for more than 5 years with a 10-year loan. Now, obviously, both of those are long-term, but you get the idea. Another thing to think about here, though, and I don't think the authors really delve into this, so let me raise this with you. If we think about what's known as the yield curve, and I'm not going to get into the specifics of what kind of instrument. We can look at a treasury yield curve. We can look at a variety of yield curves. I'm less worried about that than the basic concepts here. So on the x-axis, we have maturity of the debt. On the y-axis, we have the coupon cost of the debt. All right. So here you could think of, here's 3-month debt. Here's 6-month debt. Here's 1-year debt. Here's 5 years. Here's 10. Here's 20. And finally 30. So we go from short term to very long term. Now, a typical yield curve is going to look like this. All right. It's going to be upward sloping, and it's going to be increasing at a decreasing rate as maturities extend. So here's the upward slope to it. But notice that the curve is leveling out here. So the difference between, say, a 20-year and a 30-year rate is fairly small. But the difference between maybe 6 months and a year is considerably larger. So if we're in a world like this, and an upward sloping yield curve is the typical yield curve that we observe. So here's the reason why, another reason, I guess, that we would want to finance most of our current assets with current liabilities, and that is we'd be in this portion of the yield curve. We would have lower rates. We'd be able to finance those short-term assets with lower rate short-term debt, short-term liabilities. Now, if we were to finance it with longer-term stuff, we'd be out here or out here, and we would have higher rates. Don't want that. That's a mismatch. That can't be good. That's not efficient. Not to mention the fact that, we're financing something over a longer period of time than necessary, and then we're paying a higher rate for that. So that doesn't make sense. Now, there are situations, and let me erase this yield curve. I'll leave the axes here. And let's look at a yield curve that is inverted, what's known as an inverted yield curve. And maybe it's not even this shape. It might be flat. It could have a bump in it. All kinds of odd combinations might be possible. But let's keep it as an inverted yield curve. Or maybe it's, I'll just leave it there. Now, this is not uncommon either. We sort of see something along these lines right now. If anything, if it's not inverted, it's at least flat. But last time I looked, it was inverted. Haven't looked at it recently. But basically here we have higher rates in the short term period, under a year, than in the longer term out here. All right. Some people think that this is a precursor to a recession or a downturn in the economy. That is not true. There are some periods of time where a recession was preceded by an inverted yield curve. But that doesn't necessarily mean that every recession is preceded by a downward sloping yield curve, or that every downward sloping yield curve results or is followed by a recession. But let's say, so forget about that economic prediction, if you will. It's not particularly good at that. But if we're thinking about it from a short-term financing perspective, if we see a situation like this, all of a sudden, maybe we don't care that net working capital is growing by a good bit, because we're actually financing these short-term assets, these current assets, with long-term debt that is actually cheaper. So if we can load up on that, okay, not a big deal. But what we don't want to do is we don't want to load up on it when there's an upward slope. That would be a major mistake. All right. All right. So just a little bit of a deviation from where we were in the text. Let's see. Let me get back out of here and get back to the slides. Okay. So anyway, let's keep going on to, now we're going to be looking at how do we figure out how much cash do we need to have on hand? And if we don't have sufficient cash, how much will we need to borrow in the future? The reason for this is that we don't want to wait till the point where our checks are starting to bounce. We want to be proactive here. We want to be able to go to our banker ahead of time and say, look, this year I need a line of credit of at least $50 million. Banker signs off on it. We've got the line of credit. It's sitting out there, and we tap into it whenever we need to. Now, the example that we're going to work through here will help you to see how that's calculated. And I think probably the example is the best way to figure out how that actually happens. So what we're going to do is we're going to look at, the cash receipts. These obviously come from sales. That's cash inflows, right? And then we're going to deal with all of the cash outflows as well. All right, so here's the setup. We have quarterly revenues and expenses. So Q1, we bring in 500 million in sales. Q2, 6. Q3, 650. Q4 is 8. And then the next year, Q1 is 550. So there's some sort of cyclical nature or seasonality in this possibly. It looks like maybe this is a retailer, right? When do retailers make most of their sales? It's that Q4 period. So sales are lighter in Q1 and Q2, and then Q3 and Q4 is when they actually make enough money to actually turn a profit. But we need to get through Q1 and Q2, have sufficient cash laying around to have pay those cash outflows until the bulk of the cash inflows come in. All right. So that's sales. We have receivables that start off with a balance of 250 million, and the average collection is 30 days. We have accounts payable, which are 50% of the next quarter's sales. So what they're saying here is that basically our cost of goods is 50% as well, right? So when we sell something for 500 million, our cost of goods sold is going to be 250 million. Beginning payables balance is 125, and we have a accounts payable period of 45 days. And then other expenses, we've got wages, taxes, everything else is 30% of sales. And then we've got interest and dividend payments of $50 million every quarter. And then finally, we have a major capital expenditure, CapEx, of 200 million in Q2. And then the initial cash balance is 80 million. And we require that we maintain, let me bring this up here, that we maintain a minimum of 50 million in the cash account. Just a little bit of a buffer there, just to make sure that if we've made an error, if these periods get stretched, if the payable period shrinks or the receivables period stretches out, that we're still covered, whatever occurs, and we get the sufficient line of credit that will carry us through. Okay, So I've color-coded this. We've got the receivables here that we're going to be looking at, and they're in green. Now we've got average collection period is that 30 days. This implies that 2/3 of our sales are collected during the quarter, and then that final third of the quarter, that final month in the quarter, isn't collected until the following quarter. Right, so that means that 1/3 are collected in the next Q plus 1. All right, so we start off with our balance here. We have sales of 500 million, and then we have cash collection. So we're going to collect this 250, and we're going to collect 2/3 of the sales in Q1. So 2/3 of the 500. Sorry, shouldn't be scratching over that. So we're going to collect 2/3 of this. All right. And the total there is going to be 583. So that's the 250 plus 2/3 of the 500 in sales in Q1. That next third is going to come in Q2. All right, so when we do that, we have ending receivables of 167. That's the 1/3 of sales in Q1. All right, now that is our beginning balance, obviously, in Q2. We have 600 in sales in Q2. We're going to collect 2/3 of that. So that's another 400 plus the 167 gives us 567. And we're going to have 1/3 of that left that carries over into Q3. So that's where this 2 comes from. And again, that becomes the beginning. And we just cycle through all the other quarters, Q3 and Q4. So hopefully that gives you, and I'll get out of the way, that last ending receivables on Q4 is 267. All right, so now we've got the receivables taken care of. Okay, so here we are on accounts payable. We have a payables of 45 days. We pay back our payables on a 45-day window. So half of the purchases will be paid for each quarter, and the remaining will be paid in the following quarter. Now, here's the other little twist, pardon me, and that is that the purchases for one quarter are made in the prior quarter. All right, so we only are buying, our cost of goods are only 300 million on a sales level of 600. All right, half of that gets paid for in the prior quarter, so that's 150 gets paid actually in Q1. So we have a starting balance of 125, right, plus 150, and that leaves us with a accounts payable that we have paid out of 275. So this beginning balance gets paid in 45 days, and then the additional 150 of the purchases for Q2 also get paid during Q1. All right. Then 30% of our production in Q1 is wages, taxes, and other expenses. That's back here where we have 30% of sales. All right. So that's 150, 30% of the 500. And then finally, every period, we have 50 million paid out in interest and or dividends. So here is the 50. So our total cash outflow in Q1 is the sum of these three items, this one, and this one. And that ends up being $475 cash out. All right, so now we go on to Q2. And in Q2, we have to pay that 150 from the purchases back in Q1 to support the sales of Q2. So we paid 150 in Q1. Now we're paying the other half of that 300. So another 150 gets paid in Q2. We also pay half of the purchases that we make for Q3, and that's based on an expected sales of 650. So that would be 325 million in purchases. We only pay half of that, so that's 160. They rounded off to 163. It's actually 162.5, but rounding error is not a big problem on this. So we have an additional 163. So these two together make up this 313. So that's the amount that we pay out on accounts payable in Q2. We also have 30% of our Q2 sales that are wages, taxes, and other expenses. So that's where the 180 comes from. So that's 30% of Q2 sales. And then we also were told that there was a CapEx, a capital expenditure in Q2 of 200 million. So that's where that comes from. And then we still have our interest and dividends making up another 50 million. So our total cash outflow in Q2 is 743 million. We do a similar thing for Q3 and Q4, and obviously that's why we need the Q1 of the following year's sales figures so that we can figure out what our purchases are here in Q4. But I'll leave those for you to work through on your own, but use that same process that I just demonstrated in Q1 and Q2. All right, so now we're going to take both of those. We're going to take the cash receipts and we're going to take the cash expenses. We're going to add them together. Obviously in Q1 we have a net inflow of 108. We have a beginning balance of 80. And that means that we're going to have an ending balance of 188. We're actually going to subtract off the 50 so that we never want our cash balance to drop below 50. So that leaves us with a surplus of 138 million. All right. Now in Q2 we have cash inflow of 567. Outflow of 743 for a net cash outflow of 176. We've got a beginning balance of 188, and that net outflow of 176 leaves us with only 12, meaning that if we're going to have that minimum balance of 50, we have a deficit of 38 million. So that in Q2, we already know that we're going to need to borrow 38 million. We have to raise that from somewhere. Q3, the inflows just slightly exceed the outflows. That means we have a inflow of 26 million with that beginning balance of 12. And so we have a ending balance of 38. We're still 12 million shy. So we're going to have to continue that loan through into Q3, and then you'll notice that in Q4 that's when everything is copacetic, when our big sales occur, and we have a positive inflow of 123. That means we have an ending balance of 161, so a surplus of 111 million in Q4. All right, so it's these two periods where we're going to need that line of credit. We're actually going to draw down on that line of credit, a total of 38 million. All right. So that's our cash budgeting. That's basically now an accountant or the person responsible for the cash budgeting may actually do this on a monthly basis even, just to get a finer tune on what's necessary here. But ultimately, we need to have a line of credit of at least 38 million in order to support us for that period of time. Now, let's go on and look at the last part of this chapter, possible financing. Now, I've already mentioned the line of credit. This is what most companies use. They have a revolving line of credit. They can withdraw it at any point as long as they don't exceed a particular amount defined by their line of credit agreement. And so you would just want to make sure that, in the case of our example company here, that we had at least 50 million, and we'd probably it wouldn't be bad to have a $75 million line of credit just sitting out there just in case. We don't expect to draw down, but a little more than about half of that. But I would rather have it sitting out there, and yeah, it does cost us a little bit to have it there. Maybe we push it down to 70 or 65 million, but I'd rather err on the side of having too much and paying a little bit more to have that sitting out there than not have sufficient amount and then start scrambling from other sources, because they're always going to be more expensive. And the other sources are here. So one thing we could do is factor our accounts receivable. Factoring is just horribly expensive. It certainly depends upon the quality of our accounts receivable and the amount of bad debts that we incur. But no matter what, if we try to factor them to get some cash, in other words, factoring is basically the idea of taking your accounts receivable, selling them to a third party, and then they give you so many cents on a dollar of accounts receivable. You get more cents, the better the quality of the accounts receivable. In other words, the less likely that the customer that has those debts is going to pay them. But still, even in a good situation, you're going to lose a lot. It's going to be very costly to factor your accounts receivable. You could do an inventory loan, so use your inventory as collateral and minimize the cost a little bit. But both of these are, fallback positions. I would much, much rather have a line of credit that's already sitting out there ready to go. Some other sources, bankers' acceptances, that's a possibility. A banker's acceptance is usually something that gets generated in an import-export situation. So not all companies are going to be able to sell a banker's acceptance, and there again, it depends upon the quality of that banker's acceptance. Now, a banker's acceptance is usually very high quality, but a buyer of that might see that you're in distress and try to demand a better rate. So I would want to steer clear of that. Now, commercial paper, that's a different story. Commercial paper can be quite a useful tool and can be a substitute for a line of credit. The only problem with commercial paper is that it's very difficult for smaller companies to have access to that market. You have to have extraordinarily good credit, and so we're talking about blue chip companies are the only companies that typically have easy access to commercial paper. So again, in most cases, this we probably don't want to do banker's acceptance. We don't want to factor if we can avoid it. Inventory loans, maybe, but and then commercial paper, probably not available to most firms. So I go back to this, it better be a line of credit. You better have something out there. And you want to go through this cash budget exercise either on a quarterly or a monthly basis, just to make sure that you know where you stand. And you know how big a line of credit you need. Walk into the banker's office with that, and hopefully you can negotiate some reasonable terms. And that's about it for chapter 26. So have a good evening.